Welcome back to AlphaForge AI, where we turn earnings season into survival training. This week it's simple: AI gold rush or GPU hangover. The biggest names in tech are about to open their wallets. Now let's find out if customers actually show up. The market has been willing to fund an AI build-out measured in tens of billions. New data centers, cutting-edge GPUs, custom silicon, and a race to chip AI features everywhere you work, search, shop, and scroll. But that checkbook closes fast if earnings don't confirm one simple thing: customers are paying for what's being built. This week and next, mega cap platforms face a stress test. They're being asked to prove two things. One, that cloud capital expenditures are converting into durable revenue and margins. And two, that platform AI rollouts, from copilots to generative ads to AI-enhanced search, are hitting real user and enterprise adoption. In a market this concentrated, a few lines of guidance on capital expenditure, capex, gross margin, and AI attach rates can swing the whole tape. So let's set up the week, name names, and see who's actually turning AI hype into hard cash. We'll start with the macro: how the AI infrastructure cycle is colliding with customer budgets and power constraints. Then we'll go ticker by ticker across the big platforms and key suppliers: Microsoft, Alphabet, Amazon, Meta, Oracle, Nvidia, Broadcom, AMD, TSMC, and ASML. Framing what just happened, what to watch next, and one risk that could break the setup. We'll wrap with positioning ideas for both traders and long-term investors, the bull versus bear case, and my personal take on all of this. So right now, AI spending is led by investment first, profit second. Big tech players like Microsoft, Google, and Amazon are spending billions building the foundations: powerful chips, faster networks, and giant data centers to train and run AI models at a massive scale. That spending is now bleeding into the entire supply chain: foundries, lithography, packaging, accelerators, networking silicon, and into platform layers where monetization depends on usage, value capture, and cost control. The bottlenecks are shifting. Supply of top-tier chips is finally improving, but power availability, cooling, and interconnect capacity are now the constraints. Meanwhile, enterprise buyers are moving from pilot to production, but the monetization curve isn't uniform. AI makes money in different ways depending on where it lives. In tools like Microsoft Office, it's extra features that justify higher subscription prices. In search and ads, it's about better click rates and higher returns. And in the cloud, it's renting out GPU power and services that keep customers locked in. This quarter is really about one thing: whether spending to build AI is slowing while money from using AI finally starts to grow. The companies that can show that turning point, steady cloud growth, rising usage, and smart spending, are the ones proving AI is more than just hype. Let's start with Microsoft. Microsoft will report its quarterly results on October 29, with the earnings call scheduled for 2:30 p.m. PT or 9:30 p.m. UTC the same day, providing segment-level commentary across intelligent cloud, productivity, and business processes, and more personal computing. So why does it matter now? Microsoft is basically the purest top-to-bottom AI platform story at mega-cap scale. Azure is the GPU forefront and managed stack. GitHub Copilot and Microsoft 365 Copilot are the enterprise AI workloads. The OpenAI partnership fuels model access, and the Edge Windows layer ties it in distribution. The big question for Microsoft is actually simple: is Azure's growth speeding up thanks to real AI usage, and is the money coming in matching the billions they've been spending to build it? Watch how management frames AI contribution to Azure growth and whether GPU supply constraints are now giving way to inference monetization, especially in data, security, and developer services. Expect details on Microsoft 365 Copilot adoption in enterprise SKUs, GitHub Copilot seat growth and monetization, and Azure ML or AI services attach rates. Pay attention to how Microsoft talks about profits. Are AI costs coming down because servers and GPUs are being used more effectively, or are they still dragging on margins? That's what tells us if all this investment is really paying off. Watch 3 key things. How fast Azure is growing and how much of that comes from AI, how quickly people are adopting Microsoft Copilot, and what Microsoft says about future spending on AI data centers. The key risk: if AI attach rates stall, or if power networking constraints limit deployments, capex could outpace monetization and pressure margins. Next, Alphabet. Alphabet earnings are scheduled for October 29 with a conference call at 2:30 p.m. PT or 9:30 p.m. UTC, covering Google Cloud, Search, YouTube, and other bets. So why does it matter now? Google's AI strategy spans Gemini across consumer and enterprise, Vertex AI for developers, and a growing focus on AI overviews and ads products that must defend search economics. Investors want clarity on 2 fronts: whether Google Cloud growth benefits materially from AI platform wins, and how AI-infused search impacts ad yield and cost to serve. The interplay between AI answers, user engagement, and advertiser ROI is the heart of Alphabet's valuation debate this season. Expect management to discuss AI in search and YouTube, creative tools, assistive features, Google Cloud's AI platform economics, and the balance between first-party models and open customer choice stacks. Listen closely when Google talks about its AI spending, especially on data centers and its own chips called TPUs. That's what shows how fast they're investing and how soon that money could come back as profit. So here's what to watch next: Google Cloud revenue and operating margin trajectory, ad revenue resilience as AI features roll through, and a granular capex guide tied to AI buildout. The main risk is if AI search features dilute ad monetization or increase unit costs without offsetting yield, margin leverage could disappoint. Okay, let's move on with Amazon. Amazon's earnings call has been set to October 30 at 2 p.m. PT or 9 p.m. UTC with AWS North America and international detail. Why does it matter now? AWS is still the main hub for running AI models. They rent out GPU power, build their own chips like Trainium and Inferentia, and now offer AI tools through their Bedrock platform. Investors want to know, is AI actually speeding up AWS growth? Are customers spending on higher value services? And are Amazon's own chips helping to cut costs now that GPUs are easier to get? Watch for signs that companies are moving from testing Amazon's AI tools to actually using them in production, and whether more customers are joining Bedrock's AI marketplace. Capex guidance and commentary on data center expansion, power procurement, and networking architecture will signal where AWS is in the AI investment cycle and how unit economics are trending. Here's what to watch next: AWS growth re-acceleration, AI service mix, and capex cadence with particular focus on returns and power availability. One big risk: if most AI spending comes from just a few giant clients, or if Amazon's custom chips don't save enough money, revenue might rise, but profits could still fall. Okay, let's continue with Meta. Meta reports on October 29, 1:30 p.m. PT or 8:30 p.m. UTC, with an earnings call and a community update that has increasingly focused on AI, Reels, and platform investments. So what's the state of Meta's AI game? Meta's AI thesis is essentially dual track: AI native ad tools that lift campaign performance on the one side, and AI assistants or creation tools that enhance engagement and require serious compute infrastructure on the other side. Investors are focused on the balance between higher capital expenditure for AI infrastructure and the monetization via ads yield and new services like messaging. Meta's result will show whether its massive AI investments are actually improving ad performance and boosting how much money they make from each user. Enough to justify all that spending? Expect updates on AI creative tools, Advantage Plus adoption, and infra capex tied to Llama model development and inference at scale. Any detail on power constraints or data center redesigns, including networking and liquid cooling, will help investors model timing of spending versus benefit. Here's what to watch next. Ads revenue growth and ROI improvements attributed to AI are key. Then there are capex and expense outlook for the AI infra and progress on AI assistance for messaging monetization. The key risk is that if ad yield gains plateau or engagement shifts undermine monetization, higher AI OPEX or capex could compress operating leverage. Next, let's talk about Oracle. Oracle dropped its latest earnings recently, and the numbers were wild. Cloud revenue jumped 28% year over year to $7.2 billion, and Oracle now expects its cloud business to grow 77% this fiscal year. The real eye-opener, their backlog. Those are basically all assigned AI contracts that haven't turned into revenue yet, surged 359% to $450 billion. Honestly, that's not a backlog, that's a monster. Larry Ellison's probably somewhere laughing in SQL. They're also rolling out 37 new data centers from major cloud partners like Microsoft and Google. Part of what they call their multi-cloud push, letting customers run Oracle databases inside other clouds too. So why is this important right now? Basically, this is the cleanest AI spend real data point outside the hyperscalers like Google, Microsoft, and Amazon themselves. Bookings, RPO, are parabolic, while Oracle is leaning into capex and power buildouts to turn those orders into capacity. If those AI contracts translate to consumption at pace, the Oracle Cloud Infrastructure OCI's revenue curve can outrun depreciation and validate the gold rush thesis. If utilization lags, it flips to budget blowup. Focus on number 1, OCI consumption versus committed backlog. Management actually said customers are burning through computing credits faster than expected, so real-world usage is rising even quicker than reported revenue, which means that backlog could soon turn into real cash flow. Number 2, multi-cloud ramps with Microsoft, Google, and Amazon that widen distribution. And number 3, capex or power timelines to stand up clusters. Oracle's pouring billions into new AI data centers, but most aren't fully powered up yet. That build-out drags on profits for now. Lots of costs, not enough usage, but once those servers fill up, margins should bounce back fast. Keep an eye on these 3 indicators. First, how fast that backlog turns into real revenue. Are customers actually using what they booked? Second, margins. AI infrastructure costs a lot upfront, so we'll see if profits hold up as usage scales. And third, power and buildouts. How quickly can those new data centers and GPU clusters come online? That will show whether Oracle's AI boom is just on paper or happening in real time. Next on the list is Nvidia. Nvidia reports later in the quarter, most likely around November 20, with precise time and webcast details are on their investor relations site. Management typically gives granular product and data center commentary, including supply, demand, and product transitions. So why does it matter now? Well, even when Nvidia isn't reporting the same week, its commentary sets the tone for hyperscaler capex, network architectures, and the pace of training to inference shift. Whatever Nvidia says basically decides if the rest of tech gets to have tendies or ramen this quarter. Investors will be parsing hyperscaler remarks this week for hints about Nvidia's unit demand, product mix, and competitive dynamics versus custom silicon and alternative accelerators. Here's the setup. The center of gravity is shifting toward inference efficiency and total cost of ownership. Expect markets to triangulate hyperscaler capex guides and AI consumption data points with Nvidia's later commentary on supply normalization, networking attach, and software stack monetization. Here's what to watch next. First, signals on accelerator orders, then networking growth and the cadence of new platform ramps, as well as any color on pricing or mix. The key risk is that if hyperscalers concentrate spend in custom silicon or defer upgrades due to power constraints, Nvidia's growth curve could flatten. Next in line, Broadcom. Broadcom just had a record quarter, pulling in about 16 billion in revenue, up 22% from last year. The real engine was AI chips, which jumped 63% to 5.2 billion, plus solid results from their VMware software business. Management even guided next quarter higher to around 17.4 billion. So why does it matter now? Broadcom is a key beneficiary of AI data center buildouts across networking, switches, optics, custom silicon, and custom accelerators for large accounts. The big question now, how long hyperscalers like Amazon, Microsoft, and Google keep spending heavily on networking and custom chips? That spending directly shapes Broadcom's growth and profits. If they keep pouring money into AI infrastructure, Broadcom keeps winning. If they slow down, the momentum fades. Listen for updates on AI networking demand, merchant switch silicon, optical attach, and custom silicon momentum. The market will be matching hyperscaler capex signals with Broadcom's backlog and lead time commentary to gauge sustainability. Here's what you need to pay attention to. Number 1, networking revenue. Is it still climbing quarter to quarter? Number 2, custom chips deals. How full is Broadcom's order book? And number 3, margins. Are profits holding up as AI becomes a bigger slice of sales? One key risk for you as well. If big cloud players shift to their own in-house chip designs or delay building new data centers, Broadcom could feel that slowdown fast. Next on my list is AMD. AMD's earnings is scheduled for November 4, 2 p.m. PT or 9 p.m. UTC, with data center AI segment level detail featured in recent calls. So why does it matter now? AMD's AI strategy depends on how well its chips compete, how strong its software ecosystem becomes, and how many big partners start building with its technology. The hyperscaler prints this week will indicate how much share AMD is winning in training and inference, and whether customers are standardizing across multiple accelerator vendors. Watch for commentary around accelerator shipments, software stack maturity, and customer deployments at scale. Any signals on pricing, utilization, and total cost of ownership advantages against alternatives are key to modeling adoption. Here's what to watch next. Hyperscaler references to multi-vendor AI strategies, AMD updates on data center GPU production ramps, and customer pipelines. A key risk is that if software stack maturity lacks or ecosystem support is thin, hardware wins may not translate into sustained deployments. Up next, TSMC, the company that quite literally builds the world's AI chips. If Nvidia is the chef, TSMC is the kitchen, and they're running out of ovens. In Q3 2025, they pulled in about 33 billion in revenue, well above expectations with a strong 59.5% profit margin. They also trimmed this year's spending to around 40 to 42 billion. And about 70% of that is going straight into their most advanced chip lines. TSMC management says they're rapidly expanding their advanced packaging capacity, so that's a tech used to stack and connect AI chips together, to clear out bottlenecks that have been slowing GPU production. So why is this important right now? TSMC is basically the factory behind almost every major AI player, from Nvidia to AMD to Apple. When they talk about spending on packaging, they're giving us a direct read on how strong AI demand really is in heading into 2026. So here's the setup. Keep an ear on 3 things. First, how much of their chip output is coming from the newest advanced nodes. Second, whether that new packaging capacity actually catches up with AI demand. And third, how available high bandwidth memory chips are. That's the data fuel AI models run on. And here's what to watch next. Are their packaging lines keeping up with all the new AI chip launches? Does spending flatten or ramp back up next year? And will AI orders stay hot, or will TSMC need to lean more on smartphones and PCs again if things cool off? Now, let's talk ASML, the company that makes the machines every chip maker depends on.
You shall not pass!
They're the only ones with the keys to the chip kingdom. and somehow everyone else is still waiting outside like it's a Taylor Swift ticket drop. In Q3 2025, ASML pulled in about 7.5 billion in sales, with profits holding strong at a 51% margin. They booked 5.4 billion euros in new orders, most of that for their high-end EUV lithography tools, the machines that print the tiniest chip circuits in the world. Management guided next quarter even higher, up to 9.8 billion euros, and said they don't expect 2026 to be weaker than this year. So why does it matter? Because ASML's machines are the gatekeepers of AI capacity. If TSMC, Intel, or Samsung want to make next-gen AI chips, they need ASML's EUV and new high-NA EUV systems. So strong bookings here tell us one thing. The AI build-out is still going full speed, even if demand from China cools next year. So here's what to track. First, how fast chipmakers keep ordering those new high-NA tools. That shows how much AI manufacturing is coming. Second, the mix between memory and logic chips, because we're finally seeing memory spending tick back up. And third, any hint of export limits or supply bottlenecks that could slow deliveries in 2026. And here's what to watch next. Will ASML's backlog keep growing as foundries boost their capex? Does the China slowdown dent global demand, or do the US and Europe pick up the slack? And will lead times, the wait between order and delivery, start to normalize as fabs gear up for the next wave of AI and high bandwidth memory chips? So let's talk about how to position ourselves for this. For traders, this stretch is all about the gap between the hype and the numbers. What companies say they spend on AI versus what that spending actually earns. The first clues show up in cloud growth, AI service adoption, and profit margin. If a company beats expectations while keeping spending in check, that leadership can last. But if the bills rise faster than payoff, those stocks usually get punished fast. For long-term investors, the focus is staying power. Because if you can't stomach a little volatility, this market will gladly teach you emotional discipline, the hard way. So look for AI revenue that's spread across more than just GPU rentals. Think software, data platforms, and custom chips that keep customers locked in. The broader and more profitable the platform, the more durable the growth. Position sizes should stay tight around earnings, with clear risk limits, and always be ready to pivot when guidance surprises. Not financial advice, of course, just a way to stay grounded when the AI noise gets loud. Okay, now let's jump into the arena and let bulls and bears fight. First, the bull case, AI gold rush. If this is a bubble, it's the kind that mints factories. Oracle's backlog didn't just grow, it went parabolic to 450 billion, while ASML's EUV orders and TSMC's packaging lines say more capacity is coming, not less. Broadcom's AI revenue is ripping 63% year-on-year on the plumbing that ties it all together. That's not vibes, that's purchase orders. Yes, power and margins matter, but the checkbooks are open and the pipes are being laid. If anything, 2026 looks like build it faster, and in this game, speed is alpha. But here's the bear case, budget blow up. Sure, the demos slap, but someone still has to pay the power bill. Oracle's AI cloud is scaling, but even they hint at the cost side until utilization catches up. TSMC and ASML are arming everyone at once. If companies ended up being more cautious with their AI spending than everyone expected, those billion-dollar data centers still have to be paid for. The hardware keeps losing value every quarter. That's depreciation. So even a small slowdown in demand can hit profits a lot harder than it looks on paper. And if big tech throttles capex while they hunt for AI product payback, this could go from to the moon to show me the margin fast. Translation: until inference economics are rock solid, GPU rich, profit poor is a real risk. But here's my personal take. As lame as it sounds, both can be true. Bookings are massive. Oracle's 455 billion RPO, ASML's 5.4 billion in bookings, TSMC's heavy packaging expansion, And yet the gating factors are boring. Physical things, power, cooling, interconnect, and unit economics. These are the things that decide how fast those orders can actually turn into working infrastructure and revenue. So that's why the market is split. The bulls see record spending and backlog. The bears see assets sitting half utilized while data centers wait for power permits. The truth is probably somewhere in between. This isn't about whether AI is overhyped. It's about how efficiently that capex turns into utilization, margins, and cash flow. So what's my play? Rewarding teams proving conversion. So backlog to revenue, utilization, sweating assets, and unit cost wins. Think Broadcom, where networking and custom silicon scale with demand. Each of the mentioned companies fulfills these criteria in one or more ways. Subscribe and comment picks below, and I'll send you the full breakdown and rating framework I made for these stocks. I'm long execution, short storytelling. Before we finish, tell me which stocks are you watching most closely for AI capex and platform guidance. Drop your pick and the single metric you care about in the comments. We do this every week, so you're ready before the prints. Of course, none of this has been financial advice, just sparks from the forge. Remember, we're not here to give you advice. We are here to give you an edge. The market's the forge, your research is the hammer. See you in the forge.